let's get you a whole host of reactions to what's gone on through the course of the day, both with regards to the RBI rate cut, the impact on equities as well as the money market. First up, a leading corporate voice. We have Sunil Munjal joining us with his take on the impact this will have on corporate India. Good afternoon, Mr. Munjal. Thank you very much for speaking with us. Do you think this decisively helps the economy turn around?
So one thing is for sure, by announcing this, other than at the policy statement time, it's a very good signal that the Reserve Bank is giving that we can potentially look forward to a lower tax regime, lower interest rate regime in time to come. However, a 25 basis points reduction does not meet the expectation that had got built up with lower inflation and lower global oil prices.
So what is your expectation, Mr. Munjal? What would you like to see the RBI do for this to be a decisive economic recovery, or at least an aid to a decisive economic recovery with regards to corporate India investments?
So for the last few months, industry has been asking for a 50 basis point reduction. But if you now see the continuous low inflation for a while and a wholesale price index inflation at near zero, and the global oil prices dropping below 50, plus indication of some of the experts saying that it's likely to go down even further, I would imagine 100 basis points at this moment would be highly justified. And they don't have to do it in one shot. They could probably do it in stages, but in quick stages, so that the mood in the industry changes, the consumption starts to pick up, and the decision-making of the investors who are looking to make large investments in projects also turns positive.
Mr. Munjal, hi, good afternoon. As the head of India's largest two-wheeler company, we'll also have maybe, a petrol price cut today. And with the kind of petrol price cut we have seen in totality and the likely interest rate cut over the next 1 year, do you think you're likely to see significant impact on two-wheeler sales this year in terms of sentiment and in terms of overall sales?
So the expectation is that this would certainly help. As you know, since the excise benefit got taken away at the end of December, it impacted the markets as was expected. Now, this would certainly help because it's not as if the consumers don't need these products. It's just that their ability to acquire them gets limited anytime the prices go up or excise goes up or bank financing is either not available or is expensive. So certainly this would be helpful.
How would you characterize consumer demand at this point in time, Mr. Munjal?
So overall, if you see, the recovery in the industry has been slow and somewhat patchy. Different sectors of the industry have seen improvement, but it's patchy. It's not across the board, and it's certainly not across the country. Earlier, a few months ago, we were all expecting the recovery would take place in a few months' time, but now people are saying it's likely to take another 4 to 6 months from where we are now. Therefore, signal from the Reserve Bank is certainly very helpful.
All right, Mr. Munjal, we appreciate you joining us. Thank you very much for those quick reactions to what's taken place. There you have it. Industry hoping that the RBI moves continuously on lowering rates. 25 basis points is not enough. Markets, though, are cheering this turn in sentiment. We've got market experts Rashesh Shah, Chairman and CEO of Edelweiss Group, and Adrian Movat, Chief Asian and Emerging Equity Strategist at JP Morgan, joining us on the line from Hong Kong. Adrian, if I could come to you first on what you make of this turn in the interest rate cycle, the impact, therefore, on corporate India, on borrowing, on consumer demand, and hence your outlook on equities.
So the direction is not a surprise. The timing is clearly a surprise. And remember, a very important function for a central bank is to provide guidance, to provide a message. And so to have a sort of powerful, positive message that takes the market industry by surprise, that we're moving into a pro-growth monetary policy is very helpful. And I think this is a good wake-up call for those that have been looking at India and saying, well, how's India going to do when the Fed will be raising rates this year? And underappreciating how the dynamics in India are very independent of what's going on globally.
Does this change your expectation of how rate cuts will pan out through the course of the year, Adrian?
Absolutely. I mean, look, I think one of the big mistakes capital markets participants make is failing to accept that it's a surprise. This is a surprise. This is much faster than we thought the RBI would move. We thought the RBI would be, concerned about the base effect being less favorable for the first quarter, and perhaps be more cautious about moving. They've signaled that they are very willing to look through the fact that on a sequential basis inflation has ticked up, and that they're thinking about the prospects of inflation in a year in which global commodity prices, energy prices are coming down. Remember also the Indian economy has been growing below potential for a relatively protracted period. The IP number was better than expected, but a 3.8% growth in IP is pretty anemic for an emerging economy. So I find this very constructive and great news for the economy, and clearly welcome news for the market.
Adrian, hi. You already have an overweight stance on Indian market. In fact, you've had that for quite some time now, ever since the regime change in India. Do you think it's time to add some more weight to India compared to other emerging markets?
Look, I think this is a reason to buy India. Whether I need to go overweight, I'm not sure if that's possible. We're bullish the market. We think it's going up. We think it's going to outperform EM. I think maybe where this has an impact is that global investors are very underweight emerging markets. India is a major emerging market that is doing well, as is China. People have concerns about Russia, but Russia is only 3.3% of the EM benchmark these days. I think this is a big wake-up call that more capital needs to go into emerging Asia from the global investor.
Adrian, you mentioned that this came as a surprise. Therefore, I'm asking what your expectation of rate cuts now will be after today's action for the course of 2015?
Yeah, I'm not going to answer that because Sajid, Jahangir, and I will need to sit down and discuss how they're going to modify their forecasts. And so I think it's appropriate to wait for the formal change.
Okay. You did mention this would attract more foreign investor interest into Indian markets, especially those that have been underweight EMs or India. Which sectors, and I'm guessing your response will be rate-sensitive sectors, but which sectors do you see benefiting the most in the near term and the medium term, and therefore where do you think increased appetite in buying will come in?
Well, keep it simple, as you say, rate-sensitive sectors, near cyclicals like banks, and general domestic cyclicals. That's what you buy when monetary policy moves pro-growth.
Okay, Adrian, what about something like staples, which have had a big rally in India this month? Do you think they'll take a bit of a backseat now, and it's all about beta from here on?
Yeah, I don't see any reason to add marginal money to staples. I would use staples as a funding source for more cyclical exposure.
And what about IT stocks, Adrian? They have underperformed in India, but do you think they'll underperform even more given the kind of strength that now we've seen in Indian currency?
Yes, I mean what we've had here will have no marginal benefit for the IT names. So if I was running purely Indian money, then I probably would move underweight Indian IT on this news. I think it's important, though, from a global emerging market perspective to acknowledge that Indian IT still looks attractive. Remember that this is a sector which has a very competitive currency. The domestic labor market in India is still relatively soft, so you don't have the wage pressures. We're very optimistic about U.S. growth, including U.S. corporate capex. And so India is very nicely leveraged into those particular trends.
Two questions, not directly related to what's happened today, but with regards to the weeks ahead. First one has to do with what you expect the ECB will do next week, Adrian, and how that will impact global equity markets, especially emerging markets like India. And the second one is, with the RBI having taken this surprise action today, the spotlight moves now firmly onto the Finance Minister of India and what he presents in the budget as the next big set of triggers for these equity markets. Would you agree with that? What are you looking out for?
No, what I'm looking out for in India is the activity data. PMI is high relative to where it's been in the last 2 years, but it's still not high. It's not high enough for a stock market that's priced for growth. We've talked already about the IP number, sub 4%. That needs to pick up. We need to see consumption data, two-wheeler, four-wheeler, consistently printing good year-on-year growth. That's what I'm focused on. I'm not particularly focused on the Indian budget. I think the policy direction is clear from this government. The fiscal improvements have been a function of getting rid of inefficient subsidies. Maybe the budget will tell us a little bit about priorities, but again, I think those are very well flagged by the Indian policymakers. We do expect something out of the ECB. Unfortunately, the ECB does have a track record of disappointing markets. We've had some good news on the legal front in that legal objections to QE appear to have been put to one side. But I would be surprised if the ECB could be as effective as encouraging markets as the RBI has been today.
Okay, Adrian, in terms of Indian currency, the Indian rupee, what's your call here, and what's the key risk for Indian market? What's the key risk to your big overweight call on Indian market from here on?
Yeah, so I'm going to partly use the answer I did for rates. When we get a change in monetary policy, we also rethink our currency forecast, so we're in the process of doing that. If you think about the factors that will work here, India's interest rate differential has moved against it, which would be bearish for the currency. But at the same time, this may encourage capital flows that are going into risk assets, such as the longer end of the yield curve, as well as equities. It would also arguably encourage foreign direct investment. So I think this may have a balance of payments impact that turns out to be net positive and might actually help the currency. But again, we're going back and we're rethinking of forecasts because there's been a very important event that has surprised the market and us.
Okay, I'm guessing you might be rethinking your allocation as well. And I know you stressed on rate-sensitive sectors, financials, of course, being at the top of the heap. But I'm just curious as to how much more money you think could come into financials, given the record levels we've seen the bank Nifty at, the fact that, some of this has already been priced in, the expectation that RBI will cut rates, even though this timing comes as a surprise.
Look, I think if you're asking what will foreigners do, this will make more foreigners look at the Indian market. And so I think it will be constructive. And as we discussed earlier, it makes sense to buy interest rate sensitive near cyclicals like the financials. If we think about it from the perspective of domestic retail savings pool and institutional savings pool, this will tilt people in favor of growth assets like equities. And I think it's the domestic savings pool that's particularly underallocated towards equities. And I believe this year will be very much about the domestic savings pool being the most important delta in the market.
Adrian, that's an interesting point because we are at times obsessed with FII inflows, but this market has moved despite not getting too many FII inflows. Even last year was actually not a record year with the kind of rate cuts, petrol price cuts, diesel price cuts. What kind of incremental domestic money do you think can come to equity markets in India?
Well, I don't have a formal estimate, but in that the local savings pool is underexposed, we've been through a very protracted period of time of seeing mutual fund and equity-linked insurance product redemptions in India. It's only in the last couple of months we've begun to see some sort of reversal in that trend. So I think you're looking out to a sort of multi-year allocation in favor of equities. And, really all we need is the sort of a small net flow to push equity markets higher. As you noted, there is an obsession around FII flows. One has to face the fact that at the end of every trading day, there was no net buying in a market. There was merely a change in ownership. And what we need to do is engineer an environment where foreigners are interested in buying this market, local retail is, local institutions are, and then the equity market will go up.
All right. We appreciate you joining us, Adrian, today. It has turned out to be a phenomenal day for Indian equities. Thank you very much for your thoughts. Adrian Mowat there talking you through his outlook on Dalal Street now, given this surprise rate cut by the RBI.